Citi has reevaluated its macro forecast given the fact that commodity prices have gone through the roof, and the bottom line is that inflation is going to be sticky and there are headwinds when it comes to growth as well. Now let's start with the inflation assumptions. They believe that the commodity prices might remain elevated for an extended period of time, and they're also expecting a 15 rupees uptick as far as the retail fuel prices is concerned. Palm oil, they believe, is something which will start the upward trajectory yet again, and that's the reason they believe that the headline inflation is likely to be around 5.7%, and they've revised the forecast upwards by around 70 basis points, with the inflation being higher in the first half of the coming year and taper down when it comes to the second half. On the GDP front, they have cut down their estimates as far as GDP is concerned, and they believe that GDP growth in Fy23 will be at 7.5% now versus 8% earlier, and the reason is threefold. First up, they believe urban consumption will be impacted on account of the commodity prices. Secondly, they believe that private capex might be pushed further, and thirdly, the export demand might be lower given the geopolitical tension. Talking about export demand, they believe that there will be an impact on current account deficit as well, and that could be at a multi-year high level of around 2.5%. So there as well, they have changed their estimates. Other than that, they expect rupee to be in the range of around 76 to 78 now. And lastly, as far as the monetary policy trajectory is concerned of the RBI, they believe that there would be a delayed lift-off in policy rates in October, but the stance change decision could be advanced at the meeting earlier than in August itself. So that is something that we will watch out for. Back to you guys.
Thanks very much, Anisha, for giving us a perspective as to what the outlook is from Citi on Indian macros.